Hello, my fellow investors, and welcome back to another earnings report and stock analysis video. Today, guys, we are going to go through a lot of earnings reports, specifically for the banks that had earnings on Friday. As you see on your screen, we got Bank of America, JP Morgan, Citi Group, and Wells Fargo. We also had First Republic Bank. However, I mainly just want to cover Wells Fargo, Citi Group, JP Morgan, and Bank of America. So this one's going to be fun, guys, because banks usually determine pretty much how the economy was. They are essentially the controllers of money and how money is spent and how money is lent out. So very, very important to analyze the banks. And since these were the first ones, let's take a look at all their earnings, and we'll also do a stock analysis on them as well. And of course, because this is an earnings report video and we are going to cover them, I will have all of the earnings in the description below if you guys would like to read it for yourselves. This is going to be a pretty long video, but I will have everything time-stamped. So with that said, let's get started with this analysis. All right, everybody. So we are going to start off with the company JP Morgan Chase. Coming over here into their earnings, a quick synopsis is EPS normalized actual came in at $3.57, which is a beat by 47 cents. EPS gap actual $3.57, again beat by 47 cents once again. Revenue $34.55 billion, which is a beat by 320.96, almost $321 million. And now coming into their actual earnings report. Again, all of them will be linked in the description below. Starting off, guys, this is, well, first of all, it's a pretty big report, so I'm not going to go through all of it, but I'm going to go through what I believe is, I guess, the most important parts. Let's start off with the CEO, Jamie Dimon's remarks when it comes to this. I'm only going to cover the first paragraph, though, because the guy pretty much did like a whole essay here. JP Morgan Chase reported strong results in the fourth quarter as we earned $11 billion in net income, $34.5 billion in revenue, and an ROTCE of 20%, while maintaining a fortress balance sheet and making all necessary investments. This robust earnings generation, combined with the execution of our capital strategy, allowed us to exceed our CET1 target of 13% 1 quarter early, and we have the ability to resume stock buybacks this quarter. Oh, here we go. Oh, that's actually really good. I like that news, not even going to lie. And we have the ability to resume stock buyback this quarter as we deem appropriate. Looking further ahead, we still await details of the Basel III finalization package, but we will manage to the new requirements as we have demonstrated in the past. Wow, guys. Okay, that right there, the fact that they're going to resume stock buybacks is huge, absolutely huge. Now, we do have a couple of notes over here when it comes to like how they actually did. We got reported revenue of $34.5 billion and managed revenue of $35.6 billion, including a $914 million gain on the sale of Visa B shares and $874 million of net investment securities. That's actually, wow, that's kind of insane, not even going to lie. Credit cost of $2.3 billion included a $1.4 billion net reserve build and $887 million of net charge-off. Average loans up 6%, average deposits down 4%, okay? Average deposits up 3%, clients and investments down 10%. So right now they're actually going through the CCB portion of their earnings report. The first 3 points was based off of the firm-wide metric, but CCB, this is essentially what they're talking about over here. Average loans up 2% year over year and up 1% quarter over quarter. Card services net charge-off rate of 1.62%. Debit and credit card sales volume up 9%. That is, that could actually be really, really bad, because that means that people are getting a lot more indebted than they should be. That's not good. I have heard stories that people are taking out credit cards just to pay for groceries, which is, again, not really good. Active mobile customers up 9%. Now, looking at the CIB, we got #1 ranking of global investment banking fees with 8% wallet share for the year. Total market revenues up $5.7 billion, up 7%, with mixed income markets up 12% and equity markets down 1%. In the CB, we got gross investment banking revenue of $700 million, down 52%. CB, average loans up 14% year over year and up 3% quarter over quarter. Average deposits down 14%. And the AWM, assets under management, AUM, of $2.8 trillion, which is down, what, 11%. Wow, so the assets under management actually went down. Average loans up 2% year over year and down 1% quarter over quarter. Average deposits down 10%. So overall, it was actually pretty positive, right? I mean, they did have a couple of negatives here and there, but the overall scheme of things is actually very, very positive. Now, what I want to do is I want to come here to the actual numbers and compare that to 2021. We got here JP Morgan Chase. This part is specifically for JP Morgan Chase. We got net revenue reported. Quarter 4 2021, we got $29.3 billion compared to that of Q4 of 2022, which was $34.5 billion. That is an increase of 18%. In the form of net income, we got $10.4 billion to $11 billion. That is an increase of 6%. And just as we saw when it came to their earnings share per diluted, they are at $3.57. That is absolutely massive, guys. Absolutely, but it's just absolutely massive. Just that revenue alone was just 18% increase is crazy. Next, we got the CCB net revenue. 2021, it was $12.3 billion. 2022 Q4, $15.8 billion, increase of 29%. In the form of the net income, we got $4.15 billion to $4.5 billion, increase of 10%. Coming now into the CIB, we got $11.5 billion in 2021, and then in 2022, it is $10.55 billion. That's actually a decrease. Sorry, I was about to say increase. That is a decrease of 9%. And when it came to the net income, $4.5 billion to $3.33 billion, as a decrease of 27%. In their consumer banking, we got $2.6 billion to $3.4 billion, increase of 30%, and we got $1.2 billion to $1.4 billion, increase of 15%. And lastly, when it comes to their AWM portion, 2021, $1.13 billion to $1.13 billion. Okay, to be specific, it was $1.125 billion to $1.134 billion. So that was an increase of 1%. So now let us actually come into the calculator, guys. We got the ticker symbol for JPM, market cap of $419.5 billion and a PE of 11.83 with a current share price of $143.01. Now, this current share price is insane because, well, looking at this on the 1 year, guys, they're still down almost 15%. Looking at the year to date, they're up so far almost 6%. The reason why I'm saying that this share price is incredible is because the 52-week ranges is $101.28 to $159. We aren't at the 52-week lows. Actually, we're pretty close to the all-time highs and even making new all-time highs. But take a look at this graph, guys. We were at the $101 at around like October 10th of 2022. That is crazy. Within like what, 3 to 4 months, this thing completely shot up from $101 to what it is now of $143. So if you bought this at 101, oh baby, you are sitting real pretty. Now, they also pay out a pretty good dividend of $4 in annual dividends per year, which is a yield of 2.8% even at this current price. And you want to know something? To the people that actually did buy it at around $101, you got a 4% yield. That is absolutely incredible. 2.8 though is still looking fairly good. They did not have a payout ratio according to this for some reason. The 5-year CAGR, it is double digits, which is again something I really like. 13.54% with 8 consecutive years of dividend payment. Ex-dividend day passed as of January 5th. Payout day is going to be on the 31st, and they pay their dividends quarterly. Alright guys, so now let's jump into the fundamentals. Not surprising that their fundamentals is actually going to be pretty decent. We got 5 years ago of $32.5 billion to today of $37.7 billion. That is an increase of 16.02%. Now guys, when it comes to this, you can see that 1 year ago and today is the same. It's because, well, 3 years ago now is when COVID was. So we don't have any numbers for today, 2023, so that's why they're putting it the same, just so that way the numbers actually make sense. But just understand that 3 years ago was 2020, and this was when COVID hit. Nonetheless though, you can still see a pretty good consistent increase even after COVID hit. Afterwards, they went up massively in their net income to $48.3 billion, and then they came down to $37.7 billion, as I said. But it's still looking fairly decent. This may have just been due to the fact that interest rates went up. Overall, I'm going to give this like a 75%. In the form of revenues, we see something very, very similar, though a little bit less dramatic. 5 years ago of 103.7 billion to today of 122.31 billion, increase of 18%. We do see the dip that happened here 3 years ago for COVID, going from 110 billion dollars to $102.5 billion, and then after that shooting right up to almost $131 billion. Then they came down not too much actually. They only went from 131 to 122.31, so it's still looking fairly good. I'm going to give this a little bit higher grade because the differences in these margins right here are less than that of the net income, so I'm going to go with like an 85%. Looking now at the shares outstanding, this one, it is the silent killer when it comes to investing, and you really want these things, guys, to be coming down. However, when it comes to this one's interesting. 5 years ago of 3.3 billion shares to today of 3.1 billion shares. On the 5 years, that is an increase of 6%, 6.12% to be exact. However, take a look at this. Even though they were consistently decreasing these shares from 5 to 2 years ago, after 2 years ago, they shot it back up a little bit. To be fair, they are still under the 4-year-ago value, but they definitely increased it even higher than that of 3 years ago, which was when COVID hit. So even after COVID, they bought back shares going from 3.1 billion to 2.94 billion. And then they brought it back up to 3.1 billion again. So, you know, they're pretty consistent about buying back shares. So I don't consider this increase just this 1 year a big outlier, right? Overall, they are buying back, but just keep that in mind and keep an eye on this for future reference. So overall, I'm gonna have to give this one around like an 80%, mainly because that 4.25% increase is a little bit sus. Looking into the total assets minus the total liabilities, this one's looking absolutely gorgeous. They were increasing this from 5 to 2 years ago, and only 1 year ago is when they brought it back down a little bit, going from $294.1 billion to $292.33 billion. That's not really a big decrease overall. Average total assets is $3.3 trillion. Yes, guys, that is trillion because all of these numbers are in the millions. So, you know, that's $3.3 trillion. Average liabilities is $3 trillion, and doing this difference, we get $279.33 billion. I'm going to give this a pretty decent grade of 95%. So with all of that said, we can see the net income, we give it a 75%, revenue 85%, shares outstanding 80%, and assets minus liabilities 95% for an overall grade of 82%. It's not surprising, guys, that JP Morgan is one of the biggest banks in the world, and you know, they didn't get there by not being as good as they are. So the fact that this got an 82%, yeah, I think it's pretty obvious that they're a really good company overall. So now let's actually come over here to the valuations. We got the book value per share. Banks do not have capital expenditures, so we have to use something else, and what we use is book value per share. Very, very easy to calculate. Assets minus liabilities, divide that by the total common shares outstanding, and that's what you get. Now, Seeking Alpha does this for you, so there's really is no math involved, just copy and paste, and we get this graph. As of today, their book value per share, it is $86.16. That is up 22% from 5 years ago, which was $70.36. Their peak was actually 2 years ago at $88.07. Looking now at another valuation metric, we got the tangible book value per share, which removes anything that is non-tangible. With this, the share price should now be $66.37, up 19% from the 5-year of $55.64, once again reaching the peak 2 years ago. So now what we can do, guys, is take a look at the valuations. We do this by taking the price and then divide it by these book values. Once again, we got the book value over here. We got $86.16, and the tangible book value, we got $66.37. Doing the price divided by these book values, guys, we get 1.66 for the current book value and 2.15 for the tangible book value. Basically, when it comes to banks, guys, you want to be as closest to 1 as possible, and unfortunately 1.66, it is the closest one. It is still 66 above what it should be. So as it currently stands, this is looking like a pretty expensive stock. However, let's actually change this value over here to 101, which is what it was at the lowest point. take a look at this. Now the price divided by the book value, it is 1.17, and the tangible, it is 1.52. Very, very close to that of the current share price. Very, very close to that of the share price at the lowest point. So again, if you bought at that point, guys, you are definitely looking very, very pretty when it comes to your gains at the current moment. However, if you're thinking about buying into this company right now, it's looking like based off of their book value and tangible book value, it does seem to be a bit expensive. And now analyzing this dividends at the current share price, we get 40.03 shares if we were to put in $5,725. Annual dividends becomes $160.14, quarterly of $40.03, and a monthly of $13.34. So it's not looking too shabby, but then again, for $5,725, you could still get a lot better ones in my personal opinion. And again, if you would have bought this at 101, your annual dividends would have been almost $230. So again, it really does matter what you pay for. So as it currently stands, unfortunately, when it comes to the book values, guys, this isn't looking like a buy right now. In my personal opinion, I'll be waiting for this thing to fall or their fundamentals to get better in the future. And that was JP Morgan. Now let's jump into Bank of America. This is the bank that I actually use, and I actually used to have this bank in my portfolio a while back, and then I sold it just to have JP Morgan. So let's actually take a look at these earnings, guys, and see what actually occurred with them. Looking at the quick synopsis of their earnings, we got EPS normalized actual came in at 85 cents, beat by 8 cents. EPS GAAP actual 85 cents, beat by another 8 cents. Revenue $24.53 billion, which was a beat by almost $360 million. So the earnings were very, very good to say the least. And now let's jump into their actual report. We got here Q4 2022 financial highlights. Net income of $7.1 billion or 85 cents per diluted share compared to $7 billion or 82 cents per diluted share back in Q4 of 2021. Pre-tax income up 1% to $7.9 billion. Revenue, net interest expense increased by 11% to $24.5 billion. Provisions for credit losses $1.1 billion increased $1.6 billion. Non-interest expenses increased $81.2 million or 6% to $15.5 billion, driven by investments in the franchise across people and technology, partially offset by lower revenue-related incentives compensation, operating leverage of 6%, efficiency ratio of 63%. Average loan and lease balances of $94 billion or 10% to $1 trillion, led by strong commercial loan growth as well as high credit card balance. That is actually not that good, guys. High credit card balances, ooh, that we saw something similar to that in the in JP Morgan as well. Average deposits down $92 billion or 5%. Average global liquidity sources of $868 billion. Common equity tier 1 ratio of 11.2%. Increased 25 basis points from Q3 2022. Returned $12 billion to shareholders in 2022 through common stock dividends and share repurchases. Really, really nice. Return on average common shareholder equity ratio of 11.2%. Return on average tangible common shareholders equity ratio of 15.8%. So overall, pretty positive across the board. And now let's actually take a look at the CEO's comment. We ended the year in a strong note, growing earnings year over year in the fourth quarter in an increasingly slowing economic environment. Wow. So even though the economy is slowing, and he even just said it, it's slowing, they're still doing fairly good. The themes in this quarter have been consistent all year as organic growth and rates helped deliver the value of our deposit franchise. That, coupled with expense management, helped drive operating leverage for the 6th consecutive quarter. Our earnings of $27.5 billion for the year represents one of the best years ever for the bank. What? That's crazy. Even in this economic environment, which again, he just said right here, slowing economic environment, that was their best year. Absolutely crazy. Reflecting our long-term focus on client relationships and our responsible growth strategy, we believe we are well positioned as we begin 2023 to deliver our clients, shareholders, and the communities we serve. So again, really, really positive overall. Let's come down here into the financial highlights, just like we just saw up there. We got the total revenue, $21.1 billion back in Q4 2021 to $24.5 billion in the same quarter last year. We got the net income $7 billion to $7.1 billion, and diluted shares went from 82 cents to 85 cents. And looking at it from a fiscal year perspective, we see that the revenue grew from 89.1 billion to 95 billion, and net income went from 32 billion. It actually went down, actually fiscal year through fiscal year. Yeah, it went down from 32 billion to 27.5 billion. Wow, very, very interesting. And the diluted earnings per share also went down from $3.57 to $3.19. So now let's come here into the calculator. We got the ticker symbol for BAC, market cap of $282.6 billion with a PE of 11.06 and a current share price of $35.23. So far on the 1 year, guys, they're down 27.75%, and on the year to date, they're probably up a lot. Yeah, they're up 5.13%. 52-week ranges is $29.31 to $50.11. Not 52-week lows, but still very close to that. In fact, let's actually see what they were at the lowest when it came to COVID. By the looks of it, they were down to $18, guys. So, you know, it's not as the lowest that it ever was, but it's still fairly low in comparison to other ones. They do pay out a dividend of 88 cents per share, which is a yield of 2.5%, no payout ratio, a 5-year CAGR of 17.14%, and 9 consecutive years of dividend growth. Ex-dividend date passed as of December 1st, payout date was December 30th, and they pay their dividends quarterly. And based off of the current shares outstanding, they pay out in dividends every single year roughly $7.04 billion. And now time to take a look at the fundamentals, starting of course with the net income 5 years ago of $28.15 billion to today of $27.5 billion. That is a decrease of 2.2%. Very interesting, because, well, you would think that they would have at least done better than 5 years ago. We did see a dip here 3 years ago during COVID where they just crashed. They went to like $18 billion, and then the following year they went up to $32 billion. Absolutely massive. Probably because a lot of people had a lot more money because stimulus checks were just being put out. Then after that, 1 year ago, they came down a little bit, and so far that's where they are essentially right now. So overall, seeing that this is a decrease on the net income, I cannot give this a pretty good score. I'm going to give this like at around like a 30% or so. Coming now into the revenue, this was actually looking not too bad. 5 years ago of $87.7 billion to today of $92.41 billion, increase of 5%. Again, we do see the dip here 3 years ago to COVID, going to $74.21 billion, and then they reached their peak 2 years ago at $93.71 billion. But at least in this scenario, they are higher than they were 5 years ago by around 5%. So overall, I'm gonna have to give this at around like a 75%. Looking now into the shares outstanding, this one, it is looking absolutely gorgeous. 5 years ago of 9.67 billion shares outstanding to today of 7.99, right? Let's just bring it up to 8, right? 8 billion shares outstanding. That is a decrease on the 5 year of 17.3%, and from the previous to the current year, there's another decrease of 1.01%. Really nice. And in fact, take a look at this. Not a single year, guys, did they issue shares at all. Every single year they have bought back shares. 1 year ago to the date, the reasons why these numbers are the same is because the year just switched over. That's the only reason why. We have no data for 2023, so that's the reason why. So overall, this has to get a 100%. Absolutely perfect score. Looking now at the total assets minus total liabilities, this was also looking fairly good. You can see they have been positive in the past 5 years, and not only that, they've been pretty consistently increasing. Now, they have had their instances of going down, like from 5 to 4 years ago, right? Going from 265 to 264, and then from 3 to 2 years ago, going from 273 to like 270, but then they kept bringing it back up. So you can clearly see that the trend is slightly going up. Average total assets is $2.8 trillion. Average liabilities is $2.5 trillion. Doing this difference, we get almost $270 million. I have to give this at around like an 80%. And now for the overall value, guys, I actually changed the net income to that of 60%. I looked at it, I'm just like, it really wasn't that bad, so I'm going to change it to 60%. Revenue, 75%. Shares outstanding, 100%. Assets minus liabilities, 80%. And a total grade of 78%. So, yeah, it's not as good as JP Morgan, but it's still up there when it comes to this overall grade. And now looking at the book values, let's actually see if at the current share price, this is looking like a pretty good buy. As of today, we got $30.61. That is up 22% from the 5-year of $25.13. Looking now at the tangible book value, today it is $21.98. That is up another 22% from the past 5 years of $18. So now actually taking a look at these ratios, the same way that we just did JP Morgan, let's do the exact same thing with Bank of America. Doing the price divided by current book value, we can see that the ratio, it is 1.15, which is, it's still expensive, but it's not as expensive as JP Morgan was. And the price divided by the current tangible book value, it is 1.6. Again, a little bit higher than that of the book value, but it's still not like JP Morgan, which I believe the ratio was at around like 2 or something, right? So that just goes to show that Bank of America, at least in this scenario, it is a little bit fairer value today than that of JP Morgan. Now, the fact of the matter is that, well, their fundamentals are a little bit worse than that of JP Morgan, right? So you have to really balance this out at least when it comes to these two companies. So now with that said, let's actually see how much you get based off of this dividend of 88 cents per share annually. Putting in $5,725, we get $143.01 in annual dividends, $35.75 in quarterly dividends, and a monthly dividend of almost $12. So it is fairer value, don't get me wrong, but the dividends just, I mean, 143 for $5,725. I would like above like 200 personally for me. So, you know, it really is up to you as to how you want to invest in this company. Obviously, a company is worth more than just its dividend. Don't get me wrong on that one. But as it currently stands, these are the dividends if you were to put in $5,725. All in all, when it comes to Bank of America, yeah, okay, it's one of the major banks in the United States. The fundamentals, though, in my personal opinion, the main issue is that net income. Aside from that, shares outstanding is amazing, right? Revenue's good. Book value and tangible book value seem to be in line with the current share price. So again, take it as you will, but obviously compared to that of JP Morgan, Bank of America does have a little bit more issues. So now let's jump into the third company that had earnings, and that was Citi Group. Now, if you guys have been on my channel like at all within like the past year or so, yeah, you guys know that this company has just been an amazing buy like several times. And there's actually one little problem with it that I keep finding every single time, and that is the one reason as to why I've kind of just been hesitant about even putting money into it. We're gonna get through that in just 1 second in this video, but nonetheless, now let's dive into their actual earnings. And we got here a snapshot where we got the EPS normalized actual came in at $1.16, missed by 4 cents. EPS gap actual $1.16, missed by 3 cents. Revenue came in at $18.01 billion, which is a beat by $40.43 million. So unlike the other two, this one did miss on the actual earnings, but actually beat on the revenue. And now jumping into their earnings report, they actually make it out like really nice over here. Like they just put everything like right here, like the highlights. It's actually kind of cool, not even going to lie. So we got here fourth quarter revenues $18 billion, fourth quarter net income $2.5 billion, fourth quarter EPS $1.16, ROE 5%, ROTCE 5.8%, capital ratio 13%, and they also put it in the fiscal year form as well. $75.3 billion for 2022, net income $14.8 billion for 2022 EPS $7, ROE for 2022 7.7, ROTCE for 2022 8.9, and SLR 5.8%. And look at this, they also have this here as well. It's actually really nice the way that they put this right then and there. The first thing you see, everything that a value investor would actually want to see if you guys don't really want to read the whole entirety of this thing. Returned $1 billion in dividends to common shareholders, payout ratio of 44%. You know what? Okay, great. There we go. Now we got the payout ratio right there. 44%. Really solid, guys. Not even going to lie. Book value per share. That is hilarious. Okay. You know what? Okay. This is why I absolutely adore Citi Group. This is why I absolutely adore Citi Group. They literally are just like, boom, here we go. We know what you guys like. Let's put this first page. Here you go. it just sucks that I'm looking at one profit metric just kills me every single time. But man, you gotta love management. You just gotta love management for this, right? You gotta love the board for just putting everything that I want to see right then and there. Book value per share, $94.06. And tangible book value right then and there, $81.65. Let's actually take a look at what the CEO had to say. One of our major goals in 2022 was to put in place a strategic plan designed to create long-term value for our shareholders, and I am pleased with the significant progress we have already made in terms of our transformation, simplification, and strengthening our 5 interconnected businesses, some of which delivered excellent results this quarter. With their revenues up 32%, services delivered another excellent quarter, and we have gained significant share in both treasury and trade solutions and security services. Markets had the best fourth quarter in recent memory, driven by a 31% increase in fixed income, while banking and wealth management were impacted by the same market conditions they faced throughout the year. Our cards businesses had double-digit revenue growth for our second straight quarter, and we continue to make progress on our international consumer exits, closing 5 sales to date. Over the course of 2022, we returned over $7 billion to our shareholders. We ended the year with a CET1 capital ratio of 13% and a tangible book value per share of $81.65. I even love that the CEO is saying this. This is absolutely amazing. We intentionally designed a strategy that can deliver our shareholders in different environments, and we are very much on track to reach medium-term return targets we shared on Investor Day, Miss Fraser concluded. So yeah, guys, that is absolutely awesome. I really do love Citi Group. Like, management, it's just really solid. Now, I actually want to come down here and compare their results to that of 2021. So we got here, guys, 2021 fourth quarter, $17 billion, and Q4 2022, it was $18 billion. Year over year, that is up 6%. Quarter over quarter, though, that is down 3%. When it comes to the total operating expenses, $13.5 billion to $12.98 billion. That is a decrease of 4%. Now looking at over here, Citigroup's net income. This is the part that, man, every single time I see the fundamentals, this is just a killer every single time. They went 2021 Q4, $3.2 billion to 2022 Q4, $2.5 billion, decrease of 21%. And this is a common trope that we're going to see year over year in those fundamentals. It really is sad, not even going to lie. When it comes to the book value per share, they were from $92.21 to $94.06, increase of 2%. Tangible book value $79.16 to $81.65, increase of 3%. And when it came to the way that they actually give value to the shareholder, we can see that the common share repurchases was 0, but they did pay, as we saw, $1 billion in dividends when it came to this past quarter. Again, that was a payout ratio of 44%. So now let us come into the calculator. We got the ticker symbol for C, market cap of $96.7 billion, a P of 7.02, with a current share price of $49.92. Now, looking at this, guys, when it comes to the 1 year, they're down 26.35%. And on the year to date, they're up a whopping 9%. Absolutely insane. 52-week ranges is $40.01 to $69.11. Imagine buying this at 40 bucks, guys. That is absolutely crazy. Now, they do pay out a dividend of $2.04, which is a yield of 4.09%. And if you would have bought this thing when it was at 40 bucks, your yield would have been 5.1%. Absolutely insane. Nonetheless, though, 4% still really good. They don't have a payout ratio, but we saw what it was, right? 44%. That one's perfectly fine. Still looking really good. 5-year CAGR on this dividend, 16.3%. 0 consecutive years of dividend growth. Now you're looking at like, well, all of this looks good, but why don't they have any issuing, like, why don't they keep increasing that dividend? Well, here's the reason why that growth is at 0. Basically, from 2019 to today, it's not that they cut it, it's that they have kept it the same at 51 cents every single time. So at least you're getting consistency. Sure, you're not getting that dividend growth, but 51 cents, right? It's still 51 cents. It's pretty consistent. They haven't seemed to cut it at all. In fact, they grew it a little bit back in 2018. So at least you're getting that consistency. Ex-dividend date is coming up on the 3rd of February. Payout date is on the 24th of February, and they pay their dividends quarterly. And of course, based off of this current annual dividends per share, they pay out $3.9 billion in dividends every single year. And now let's come into the fundamentals. And oh boy, one of them kills me every single time, and you're looking at it right now. Starting of course with the net income, 5 years ago $18 billion to today of $14.8 billion. That is a decrease of 17.73%. This kills me every single time because I'm looking at this and I'm just like, oh, it's such a great company. Why is their net income decreasing? I don't understand. So I have to give this, you know what? I gave Bank of America a 30, and now I'm kind of actually taking that back. I might actually give it a higher grade, but nonetheless, when it comes to this one, guys, this is really bad. I have to give this like a 20%. Looking now at the total revenue, we got 5 years ago of 65.5 billion to today of 70.56 billion, increase of 8%. Dipped during COVID to $59.6 billion. After that, 2 years ago, they went up to almost 75 billion, and then they came down to again $70.56 billion. Overall, it is still an increase, thank God. So I'm gonna have to give this a pretty good grade of like an 80%. Looking now at the shares outstanding, this one is looking absolutely gorgeous. Absolutely gorgeous. Take a look at this. 5 years ago of 2.4 billion shares to today of 1.94 billion shares. That is a massive buyback, guys, of 18.22%. And from the previous year to the current year, there's another decrease of almost 2.5%. So not only are they giving you a pretty consistent dividend of 51 cents pretty much every single year, right? And a slight increase from like 2018 to 2019. They're buying back 18% of the shares. Absolutely crazy. That's amazing. This really is amazing to see, guys. I have to give this a 100%. Notice they have never issued shares, not even one time. So 100% logical grade for the shares outstanding. Looking now at the assets minus liabilities, this was also looking really good. Not consistently increasing over the past 5 years, but the overall trend it is to go up. You can clearly see as of today, they're up to $201.8 billion. Down a little bit from 2 years ago, which was their peak at $202.7 billion, but not too bad, honestly. Average total assets is $2.21 trillion. Average liabilities is $2 trillion. And doing this difference, we get almost $200 billion. I'm going to give this grade at around like a 95%. They had 2 times where they went down a little bit, but then they recovered pretty well after that. So I'm going to give it a 95%. Actually, no. I'm going to change my mind on that one. I'm going to go with an 85% on that one because, again, they did have it go down from 5 to 4 and then from 2 to 1 year ago. And now looking at the overall grades, guys, we gave the net income 20%, revenue 80%, shares outstanding 100%, assets minus liabilities 85% for an overall grade of 68%. Again, everything looks great. Everything, the revenue, shares outstanding, and assets minus liabilities, amazing, beautiful. 44% payout ratio, consistent dividend. It's everything looks amazing. The way that they put out their earnings, it's just so beautiful in every single way. Their net income is decreasing 17%. This is my main gripe with this, man. It really is. I just can't. It's like, it really does hurt me see that net income drop by that much. It's just, I just can't give myself like the ability to give it higher than like a 20%, unfortunately. So overall grade of 68%. When it comes to the valuations, we did see this already, but let's go through this one more time. Book value per share, we got $94.06, up 25% from the past 5 years of $75.05. And when it comes to the tangible book value, we saw this one already, but $81.95, up 28% from the past 5 years of $63.79. And this is why I absolutely adore this company. When it comes to valuation, price divided by book value, guys, it is a 0.53 for the book value and 0.61 for the tangible book value. Absolutely crazy to see. And this is looking very much undervalued as it currently stands, at least from a valuation perspective, right? From a book value and tangible book value perspective. Biggest gripe, guys, is that net income. I can't do it. It hurts me. It really does hurt me. If maybe somebody in the comment section could tell me something I don't know about this net income, please mention it below, because It hurts me not to invest in this company seeing that it is this undervalued. Oh my god. And actually, let's see this. Let's actually put this thing at 40 bucks, which is what it was at the lowest point. And let's assume the exact same kind of book value that we got right here. Guys, the book value, the ratio would be 0.43. 0.43 for the price divided by the current book value and 0.49 for the tangible book value. That is very much underpriced, like very much underpriced. And again, even with the current valuation of $49.92, it's still underpriced, guys. So this is the reason why I absolutely adore Citi Group. It's just that net income kills me every single time. All in all, when it comes to Citi Group, as I said, guys, it's amazing. I love it, but it's the net income. It really is the net income. I actually came really close to investing in this company a while ago, and then I look back at it and I'm like, ooh, net income. Ooh, that's not good. That makes me a little bit concerned. And we even saw this even recently in this earnings report, that their net income also went down from Q4 2021 to Q4 2022. And now for the last of these banks, guys, it is none other than Wells Fargo. Now this one, man, Wells Fargo has a lot of controversies, am I right? And you know, they're still doing fairly good, I guess you could say, when it comes to their earnings. So let's actually take a look at this and see what we can actually learn. EPS normalized actual came in at $1.45, which was a beat by 36 cents. EPS GAAP actual 67 cents, beat by 6 cents. Revenue actual $19.66 billion, which was a miss by $375.35 million. And now coming into their actual earnings report, they actually have everything that I want, like right here, like in comparison to that of the prior quarter. But before we actually get started with this, I would like to read the CEO's comments first. We got over here, though the quarter was significantly impacted by previously disclosed operating losses, our underlying performance reflected the progress we are making to improve returns. Rising interest rates drove strong net interest income growth. Credit losses have continued to increase slowly, but credit quality remains strong, and we continue to make progress on our efficiency initiatives. Now, I'm not going to read the rest of this, guys, but again, you will have this in the description below if you would like to read it further. We got over here the financial summary. When it comes to the total revenue, we got $20.86 billion to $19.66 billion. That is a pretty big decrease. When it comes to the net income, we see another one, $5.75 billion to $2.86 billion, another big decrease. And when it came to the diluted earnings per share, $1.38 to 67 cents. There is something else that I would actually like to point out, and that is, well, the CEO kind of said it already, but take a look at this. Net interest income increased 45%, primarily due to impact of higher interest rates, higher loan balances, and lower mortgage-backed securities premiums amortization. Now, the reason why I'm pointing this out is because I figured that this would happen. Right, the higher the interest rates go, if people continue to take out loans, the banks are definitely going to get a much higher form of income in the form of interest rates, right? However, it will eventually get to a breaking point where people will stop getting more and more loans. Therefore, they may actually bring this number down into the future, assuming that interest rates continue to go up. So just keep that in mind. Very interesting that they are mentioning this in their report. So now let's come into the calculator. We got the ticker symbol for WFC, market cap of $168.5 billion, a PE of 11.5 with a current share price of $44.22. Looking at this in the 1 year, they're down 21.04%. On the year to date, they're up 5.81%. 52-week ranges is $36.54 to $60.30. Not 52-week lows, but on the lower end of this range. Coming back over here, they do pay out a dividend of $1.20, which is a yield of 2.71%, a payout ratio of 24.7%, a 5-year CAGR of negative 6.51% with only 1 year of consecutive growth. Looking at this dividend history, we can see that they cut it during 2020, probably because of COVID, to 10 cents from the prior of 51 cents. But ever since then, they have been continuously increasing it. Nonetheless, though, it is still a cut, and the 5-year CAGR, it is still in the negatives. Ex-dividend date passed as of November 3rd. Payout date was on the 1st of December, and they pay their dividends quarterly. And based off of the current shares outstanding, they pay $4.6 billion in dividends every single year. Looking now at the fundamentals, starting of course with the net income, we got 5 years ago of $22.4 billion to today of $13.2 billion, decrease of 41.13%. Wow, that is really bad. Lowest point was 3 years ago during COVID, obviously. Then they shot right back up from $3.4 billion. Take a look at this. Look at that massive drop. 4 years ago, $19.7 billion, $3.3 billion. Guys, that's a massive drop. Then they came right back up to $21.5 billion, and then they cut back down to $13.2 billion. I have to give this like a 5%. This is absolutely atrocious. Looking now at the revenue, we got 5 years ago of $84.7 billion to today of $72.3 billion. There's another decrease on the revenue of 15%. That's not good, like really not good. At least with the other ones, even with like Bank of America and Citi Group, at least their total revenue was still increasing. This one's decreasing. You can see 3 years ago was their lowest point. COVID again, going from $84.2 billion to $60 billion, shooting right back up the following year to almost 83, and then coming down to $72.2 billion. I have to give this once again like a 5% because that is really bad. Actually, no, I'm going to change it to like 10% because the margins of these ones were a lot less than that of this one. So I'm going to give it like a 10%. Looking now at the shares outstanding, this one's actually looking good. However, they have not been consistently decreasing it. We got 5 years ago of 4.58 billion shares to today of 3.83 billion shares. That is a pretty big decrease in the 5 year of 16.32%. And from the previous year to the current year, this is looking at 2 years ago of 3.885 billion to 3.83 billion shares. That's a decrease of 1.36%. Now, the reason I'm saying this is not perfect is because from 4 to 3 years ago, they increased it, but that increase was because of COVID. So, not really going to ding it that much, though. I will give it like a 98% for this grade. Looking now at the total assets minus the total liabilities, this one's again very interesting because the trend, it is actually to decrease. Sure, they have been positive in the past 5 years, but as of today, they're up to $181.88 billion, and that is down from their peak actually 5 years ago. Their peak was actually 5 years ago, not even 2 years ago. So yeah, the trend line, guys, is to decrease when it comes to this one. That's not good. Average total assets is $1.9 trillion. Average liabilities is $1.7 trillion. Doing this difference, we get $187.44 billion. I have to give this at around like a 40% or so. And when it comes to the overall grades, guys, we gave the net income of 5%, revenue 10%, shares outstanding 98%, assets minus liabilities 40%, for an overall grade of 35%. Out of all the banks, this is the weakest one, and we clearly see that in the form of the net income and even the revenue. That's why total 35%, it is just really bad, guys, overall. And now when it comes to valuations, as of today, looking at book value, they're at $41.96, up 10% from the past 5 years of $38.08. And when it comes to the tangible book value, this is $34.76, up 8% from the past 5 years of $32.19. And when it comes to these price ratios, we get 1.05 for the book value and 1.27 for the tangible book value. So it is overpriced, but it actually isn't that overpriced when you think about it, especially when it comes to that book value. It's pretty much in line, right? It's in line with the current share price of, again, $44.22. The biggest gripe with this is just that their fundamentals just aren't there, right? You saw that decreasing net income and that decreasing revenue. That decreasing revenue is the worst one of all of them because that's really concerning. So yeah, this may be a pretty good valuation right now, but fundamentals just aren't there. All in all, when it comes to Wells Fargo, not surprised that this is the worst out of all of them. They have had a lot of controversies in the past, and apparently they're still having controversies today. And that pretty much does it, guys, for the 4 banks that I wanted to take a look at that had earnings on Friday. Honestly, it was really good. Like, I was not expecting it to be that good. Like, the bank's earnings definitely whipped up the market up in a frenzy on Friday. Now the next ones, I guess, that we're going to see, it is, well, pretty much tech. However, when it comes to the week of January 16th, we have a couple more banks like Morgan Stanley, Goldman Sachs. However, there are a couple other ones I would like to take a look at as well when it comes to in the form of Procter & Gamble, Netflix, and Prologis as well. So be on the lookout for those stock analysis on those days, guys, as well as that weekend, because this is going to be fun. But anyways, that pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my YouTube sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis videos as well as earnings report.